From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny in for Jonathan Ferro. So what you have is tech on a ripper as the rates market tempers its ratchet higher. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up this morning, the U.S. jobless claims plunged to the lowest level since 2022. Fed officials pushed back against the rate cut expectations, and tech rallies as Apple gets an upgrade and TSMC delivers a bullish outlook. We begin with the big issue. Is good news bad news?
We're back into this kind of good news for the economy is bad news for the market.
Bad news is good news.
There's just a lot of good news.
The economy is actually doing great.
Look at the data.
You see the retail sales numbers.
Strong retail sales.
Industrial production, LEIs are bottoming.
The consumer's been really resilient.
You're seeing economic resilience.
And it seems like the whole soft landing is happening.
Fed is not going to rush to start implementing those rate cuts.
The market's a little optimistic on the rate cutting cycle.
A little too optimistic in the start of the timing of rate cuts.
The 6 rate cuts, that's a pipe dream if we have a soft landing.
The economy has been strong enough so we can keep rates stable for a while.
At some point that you will start to shift to, good news being good news and bad news just being bad news.
Good news is bad news. Joining me now to discuss that thesis, it is Morgan Stanley's Jim Caron and Seema Shah of Principal Asset Management. Seema, let me bring it straight to you. My favorite, by the way, is Ken Rogoff. In other words, we're living in a pipe dream on 6 cuts. But you say, Seema, the long-awaited downturn should arrive and depart without leaving much destruction. Inflation should continue to decelerate, and most importantly, the Fed is likely to open the door to cuts. Well, they're trying to slam that closed at the moment, Seema. My question to you is this. Are you recalibrating your rate cut trajectory in a post-Waller world? Good morning.
Good morning, Manus. Okay, so no, we're not recalibrating. I actually think that what we're expecting is very much in line with what you've just heard from a number of analysts on the street. What we're saying is, in terms of how the market is pricing rate cuts for this year, it is too soon. Too soon. March is very, very premature to think about rate cuts. At the same time, and probably more important in terms of the timing of that first cut, is how many cuts. Now, we would say that 6 to 7 rate cuts only happens if you've got a deeply negative economic backdrop, which we're not anticipating. But because inflation is coming down, it's going to come down fairly wobbly. It's not going to come down in a straight line, but it's going to get closer to that 2% level. And around mid-year of 2024, we are expecting the Fed to be ready at that point to start cutting interest rates, but to go very gradually. So we're only expecting 3 cuts for this year. So not a change in the forecast. I think at the end of last year, the market was just far too optimistic. And at this point, you can only get slightly bad news for the market.
That's why we love bond traders. It's called natural irrational exuberance. Jim, let me bring it to you. Any recalibration for you, or are you as stoic as Seema is?
So, look, I think that the Fed is likely to cut at least 100 basis points this year. And that's just really to keep things neutral, right? If inflation's coming down, which it is, the Fed needs to change its nominal policy rate to match what inflation's actually doing. So, clearly the debate is over whether it's 6 cuts, 5 cuts, 4 cuts. Is it more than 6 cuts? In terms of the markets, it's really a question of correlation. And what the correlation of returns are is that stock and bond returns have been highly correlated. The problem with that is that there's no place to hide. You can't get diversification because effectively, if stocks go down when bonds go down in returns, it's hard to have one hedge against the other. So essentially what happened is, it seems, and I think Seema was alluding to this, is that there was a large pull forward in expectations of rate cuts, and we started pricing in by the end of the year 6 cuts. If it's going to be less than that, then naturally bond yields have to rise. And because there's high correlation between stocks and bonds right now, that's going to put pressure on the equity markets. So like the premise of is good news bad news, is bad news good news, I think it's really a question of what the correlations are between returns of stocks and bonds in the markets. So, look, clearly retail sales came out pretty strong. We're seeing a strong jobless claims number that came out today. Yep. Yeah, we probably have to recalibrate a little bit.
Okay, so a moment of recalibration or reflection. Let's not force you straight into recalibrating. Let's talk about those jobless claims, as you say, this morning, and more Fed speak in the pipeline. Mike McKee is with me. Very solid jobless numbers, Mike.
Yeah, everybody always goes to the equity markets when they do their market boards. And today you want to start with the bond market because there's certainly been a reaction to the 187,000 jobless claims filed last week. That's the lowest since September of 2022, and it harkens back to pre-pandemic days. The question is it real or not? We saw a very similar move last year in the same week, and then we started going back up over 200,000 again. We'll see if that follows. But that drop also drops the number of continuing claims as well to 1,806,000, suggesting people are still getting jobs. The Philadelphia Fed number comes in still down, negative 10.6, but the number that catches your attention is prices paid, 11.3 from 24.3. That suggests still more progress on inflation. So where are we? Well, yesterday the Fed came out with the Beige Book, and the Beige Book said basically there's little or no change in economic activity and little or no change in overall employment. In other words, things are still pretty good. Chris Waller, as Manus mentioned, talked about cuts coming, but methodically and carefully this week. Raphael Bostic on the tape just before jobless claims coming out, saying he wouldn't want to cut and then have to raise. He wanted more evidence that inflation is going down. He got some mixed numbers today. We do have more Bostic this afternoon, and then Mary Daly gets the last word from the Fed tomorrow before the blackout. And I threw this in because, we haven't had a lot of change in the March estimate for quite a while, that they're not going to do much. But today we have seen a drop down to 52% chance of a Fed move in March, and that is just rapidly going away. And they still see a lot of moves in February, however, by December, however. So we'll keep an eye on that, and that'll depend on the evolution of the data. And it looks like at this point that it's going to evolve in the direction of less inflation, still more growth.
Okay, Mike, thank you very much. Mike McKee setting the table there from the Beige Book to the jobless claims. Jim Caron, Seema Shah is with me. Let's just step back for a moment, because if the recession or mild slowdown is delayed, it's not that aggressive. The rate cut trajectory, a little bit delayed, not that aggressive. The world does not fall apart. We don't know what happens in the Middle East. How does risk, how do you think asset managers, fund managers, how do you think people look at risk in this first 6 months of the year? Seema.
So I do think that the first 6 months of the year are going to be marked by a fair amount of volatility. As a year as a whole, we think it's a decent year. I think risk does okay, certainly not as well as you saw in 2023 for equities, but it's still a positive year. But in the first part of the year, because there's going to be so many question marks about when does that rate cut come, that debate continues, and it's going to rile the market. And I think Jim and I have a very similar theme going on. We're talking about it in slightly different ways. But at the end of last year, all the good news was priced in.
Yeah.
A soft landing and early rate cuts. And from there can only be disappointment. And I think so that's why you get volatility. And I think for asset managers, it's important to look through that volatility and focus almost on that medium term into what happens once you do get those rate cuts, and how do equities and credit and certainly alternative assets perform. And I think for us, it's certainly a time for diversification, but still leaning into risk.
So, Jim, let me take that across to you, because for me, as you stand on the outside as a humble retail person exposed to this, you go, actually, thank you. I'm glad to see a bit of air come out of the tires here. I'm glad to see a 9-week rally in equities stall a little bit and yields back up. Do you appreciate the opportunity that this all might present to you from a risk perspective?
Yeah, I do. And look, one of the things I always like to say is that one of the risks in the market is the upside risk. And just like any other risk, you need to hedge that risk. So if we take a step back and unpack what Mike McKee just said, we are having a decline in inflation, which is good. But the jobs market is not actually experiencing high levels of unemployment. Now, when you look at the Phillips curve and you look at most standard measures of the economy, typically what you would see is that it's required that the jobs market weakens quite a bit in order to get inflation to come down. And we're not seeing that. So what that tells us is that the consumer, as long as they keep their jobs and wages are still good, can continue to consume. And this is what's baffling the markets at this point. Everybody's trying to figure out where's the money coming from. We had strong retail sales. We had strong numbers in the third quarter, strong numbers in the fourth quarter. And everybody's waiting for this to actually pull back. So, yes, I mean, I would love to buy a dip in equity prices at this point. But what we have to recognize is that dip may be more shallow and may come faster, and that if the earnings as consumers continue to consume really get back on track, that could actually put upside risk into the markets. People are worried about downside risk. I get it. I am too. But we also have to recognize that the tail to the upside could be fatter than most people think.
I want to talk to you about credit, and I'll tell you why. I'm probably the best contrarian indicator in the world. So I'm a little bit obsessed by Rick Ryder came on the show last week, and he practically sold me everything that BlackRock could give you on investment-grade credit. And here's the story of the day. Teflon in the credit markets. We, the retail investor, have rocked up and put nearly $8 billion into credit last week. So, Seema, with that in mind, if this herd mentality is careering towards credit, are you part of the herd or are you contrarian like me?
So look, we do like investment grade credit. We like it certainly a lot more than high yield. And there's a number of reasons for that. You know, if you're expecting a bit of a slowdown, even if it's not a recession, then typically that higher quality space is going to outperform. We look at the maturity schedule for this year. It's not particularly pressing, but it's certainly more pressing for the high yield space than the IG space. But overall, look, you are getting decent yield at this point in time. As I said, I do think you need to diversify, and overall, I think credit is going to do a little bit better than you're going to see for the Treasury space this year. But it's not the time to be just solely focused on credit. We need to be looking around the rest of the market and see where the opportunities are.
Okay, well, maybe I should diversify the perspective. Jim, let me finish it off with you. Would you gorge on a little bit of credit, sir? Anything for you this morning?
Yeah, so effectively, it's really the way that we create it in our portfolio. So I do like investment grade overall as a rating for our fixed income part of our portfolios. But I do like to dabble in a little bit of high yield, a little bit of bank loans. I like to think about some of the lower quality components of the credit markets, like even in the triple C, single B sector, because the dispersion in value between the lower credit quality sectors versus high quality is actually quite wide, making the lower quality parts much, much more attractive. The higher quality part of credit is actually going to be more duration interest rate sensitive. So if rates go up for a good reason, the duration sensitivity is going to hurt you in fixed income, but the credit quality, the default risk, actually all of that can improve and you can get better valuation. So I have a very diversified mix. I'm barbelling it between some low quality and high quality. Overall, I'm coming out with exactly what Seema is saying, an investment grade overall portfolio, but I'm constructing it through a barbell.
There's no shame in dabbling in the higher risk trade. And of course, it's Rick Reader, not Ryder. Apologies to Rick. OK, team, you stay with me. Seema, Jim, we've got a little bit more work to do. Joining me now on set to talk about the stocks ahead of this opening bell, it's Abigail Doolittle. What have we got? Upgrades in tech abound.
We do certainly have an upgrade in tech, and a big one, because we, of course, into today had 2 down days for the S&P 500. But now with Apple's upgrade at B of A to a buy, that stock up 2.2%, one of the biggest weightings to the major indexes. We're looking at a bit of a rebound, despite a number of legal defeats recently that Apple has suffered from. This upgrade on the potential for Vision Pro, their virtual reality set, well, investors really liking it. Humana, on the other hand, not so much, plunging down nearly 13%. They basically pre-announced to the downside. They've cut their 2023 outlook on higher costs of care. The earnings now looking at $26 per share versus greater than $28. To end on another bright spot, though, in Manus, NVIDIA up 2.3%, as though that 240% plus rally last year weren't enough. Well, we have the stock climbing potentially to a new record high today. A bullish update from Taiwan Semiconductor on the AI space really seems to have those NVIDIA investors gunning to the upside once again.
They have indeed. 2 words: solid growth, solid quarter. Abigail, thank you very much. That's the trajectory from TSMC. Coming up, Middle East tensions, they ramp up. Twin strikes in Yemen and Iran.
They'd made 26 attacks. We'd given warning after warning, but we hadn't taken action. We have now taken action. We've demonstrated we're prepared to back our words and warnings with actions, and I believe that will make a difference.
The geopolitical factor kicking in to oil. That conversation next on Bloomberg.
They're doing it because they're backed by Iran and they've had weapons provided them to Iran. And, you know, between the 19th of November and last weekend, they'd made 26 attacks. We'd given warning after warning, but we hadn't taken action. We have now taken action. We've demonstrated we're prepared to back our words and warnings with actions. And I believe that will make a difference. This is about freedom of navigation. We want to have the freedom of navigation. It's vital not just for our economy, but for every economy in the world.
The U.S. launching fresh strikes in Yemen, targeting 14 Houthi missiles that were reportedly ready to launch. Meanwhile, Pakistan's army striking back at Iran. This is in response to the previous day's attack. Both sides signaling unease around possible escalation.
Pakistan has said that we would like to have peaceful relations with all countries in the region, including with our neighbor Iran. Pakistan considers the people of Iran as our friends and brothers, and we have no interest in escalating any situation.
And the geopolitical fear factor is seeping into the oil prices this morning, reacting on the rising risk. Escalation risk, I should say. Up over 1% on WTI this morning, 73.35. Team coverage starts now. Kaylee Lyons in Washington, D.C., Will Kennedy in London. Kaylee, good day to you. On top of tracking down the hustings around the country, you're also dealing with the news flow here in the Middle East. This is very much a demonstration of capacity by the Americans against the Houthis, isn't it?
Absolutely, Manus, but also the Houthis still do have remaining capacity, clearly, because just yesterday, right before the U.S. conducted these strikes on the 14 Houthi missiles that they said posed an imminent threat to vessels in the region, another U.S. ship was attacked, the Genco Picardy. That's at least the third ship that has been attacked since the U.S.-led strikes began back on January 12th. We have now, with yesterday's action, seen at least 4 U.S.-led strikes trying to take out Houthi capability. But because they are still clearly attempting to launch missiles, that capability has not yet been wiped out, which raises the specter of the administration, the Biden administration, continuing these targets. And on that note, we are just hearing from a televised address the Houthi chief saying things like the following. We are now in direct confrontation with the U.S. and the U.K. U.S. and U.K. strikes will not change our stance, did not impact our military capability, going on to say they are working to improve their military capability, and the Houthi chief saying they will continue attacks on ships linked to Israel. All of this, man, is feeding into concerns of broader regional conflict, in addition to, as you say, Iran, which backs the Houthis, now striking targets outside its borders, including Pakistan. Pakistan now returning an attack in kind, all of it just adding to this picture of a temperature rising in the Middle East rather than cooling off, Manus.
Indeed, it's just a question of what temperature we rise to in the Middle East. It permeates on a constant basis. There is the map that we're actually dealing with, which shows Red Sea versus the Strait of Hormuz, and therein lies the differential. Let's take that across to Will Kennedy, who is with me now. Kelly, thank you very much. Will, you know, we've coalesced a couple of times. You keep making the point, Manus, the defense mechanism is working. The missiles are being struck down. There's no choke point in the Strait of Hormuz, and for as long as that remains, then this oil market will remain well tempered.
I think that's right. I mean, we have seen oil go higher at times through this crisis, but we've yet to break decisively above $80 a barrel, suggesting that traders are aware of the situation, but they don't think it's a crisis for the oil market. We've got to think about what could change that, and I think clearly there's concern about the widening scope of the conflicts around the Middle East. We've seen incidents outside the Red Sea and Gaza, in Pakistan, in Iraq over the last week. So there is that danger there. But ultimately, the sense is that we're not going to see oil break high on geopolitical concerns until people feel that the flow of oil out of the Persian Gulf through the Strait of Hormuz is threatened, and the market isn't there yet. And I should say the backdrop is a a market that is actually considered to be fairly well supplied. We had the IEA put out its monthly report this morning, and they said, we expect demand to be stronger than we expected this year, but we also expect supply to be stronger this year, and that the market will be balanced. And while there may be a small deficit this year, when people look ahead through 2024, they're not seeing any reason fundamentally for the market to tighten strongly. So that's the backdrop, which I think is important.
Well, thank you very much. Yeah, those front spreads are tightening up a little bit as Russia, and this is the subliminal headline that we're dealing with. Russia's fuel exports bursting through their OPEC plus targets. So while the cat's away, the mice do play. Let's talk to Jim Caron and Seema Shah. Let's see what they make of geopolitics. Seema, let's put it to you first of all. Look, this is a very delicate situation in the Middle East. I mean, it's pronging on lots of directions. How underpriced is that? Briefly, Seema.
So look, I think clients are continuously asking now about geopolitics, and it's something that we're watching. Certainly, if you look at the Shanghai Shipping Cost Index, it has spiked in the last couple of weeks, which is certainly concerning. But look, I just want to emphasize this. It is quite a different situation to 2020. There are a lot of inventories, as we heard from Will, about oil, but just generally in terms of stock, we have a lot of more supply. But also, in terms of goods demand, it's nothing like 2020 where there was that surge. So actually, we're not so concerned about the inflation risk today. But of course, it is something that we're watching and could have very significant implications if it were to deteriorate to a point where it actually starts to feed through into those PCE CPI numbers.
Okay, Jim, in 40 seconds, does it matter to the American audience? It's so far away.
Yeah, it absolutely matters. I just want to pick up on what Seema was just saying. Look, I mean, the goods component of inflation has been one of the things that's been bringing inflation down. If there's any threat to that in terms of, shipping lanes or even oil or energy or anything like that, that will actually, spike inflation or could actually put upward pressure on inflation. And remember, asset prices are dependent right now on inflation coming down, interest rates being easy, Fed cutting, ECB cutting, and that propping up equity markets. So all of that together does pose a risk, given that we're predisposed to lower rates and lower inflation right now. This exhibits a risk.
Okay. Thank you very much, Seema Shah, Jim Caron there with their thoughts on the markets. Coming up, your morning calls and a conversation with Jim Breyer of Breyer Capital live from Davos. Don't miss it. This is Bloomberg. Let's punch out the analyst calls. Bank of America upgrades Apple to buy, calling an end to the company's negative earnings revisions. Next up, Wedbush cuts its Starbucks price target to $95, expecting Q1 comparable sales growth to fall short. Buy your cappuccinos. Finally, Citi downgrades Spirit Airlines to a sell. The price target there, $4, following the collapse of the planned merger with JetBlue. Coming up, Deutsche Bank's Pinky Chandra on his equity outlook. 5,100, it's on the way. We're counting down to the open, and this morning we have a moment of pause and reflection in the rates market. The equity markets are a little bit better bid. We've got a nice upgrade for Apple. Tech is on a ripper as Taiwan Semiconductors say they're going to have a solid quarter, and that gives us a lovely bump and a lift all across the NASDAQ. There is the opening bell. Joy to the Bitcoin miners there on the NASDAQ. Let's have a look at the rest of your markets this morning. You've got the euro dollar trading down by 1/8%, and yields at 4.11 as Bostic really kicks it into the long grass for the third quarter on when you can expect a rate cut from the Federal Reserve. Jobless claims are absolutely storming ahead. U.S. jobless claims plunged to 187,000, their lowest since September 2022, and crude oil up 0.8% as there is a moment of reflection on the U.S. attacks on Houthi rebels. So there is a small inflection in the war risk premium on NYMEX crude. One stock to watch, it is Humana. Now, this is an insurer. It's slashing its forecast, citing higher than anticipated medical costs. Abigail Doolittle is with me on the details. Abby.
And as a result of this bearish pre-announcement to the downside, Manus, we have this stock plunging more than 10%, heading to the worst day in more than 2 years. Now, of course, Humana focuses on Medicare. They cut their outlook for 2023. They're also forecasting anemic enrollment growth for this year relative to the 2023 profit cut. cut. They're now looking at $26 per share versus greater than $28 per share. I will note those are massive numbers, but still not what the street was expecting. And this has to do with rising costs as there's been an uptick in care usage by seniors a trend that started mid-year last year. This is also a warning call for Medicare Advantage plans. That's a private version of the U.S. healthcare program for seniors. It's driven growth and profits for some of these insurers for years, and it now seems as though it's slowing. The stock into today on some of these bumps had been down about 8% over the last year, and again today down more than 12%, heading to its worst day in more than 2 years.
Okay, well, let's talk a little bit more about tech and turn our attentions. I mean, it's been a rough 24 hours for Apple. It's, stopped selling its watches with the blood oxygen feature, and it gets snubbed by Netflix. Ed Ludlow arrives with me, I think, with a bit of good news for Apple. Ed, how you doing?
Yeah, good. I mean, I count no less than 4 clear standout stories about Apple in the last 18 hours alone. The main catalyst for the stock to the upside is a Bank of America upgrading the stock to buy from neutral, principally due to their bullishness about the Vision Pro mixed reality headset. They see that being a driver of hardware sales and services. They're also confident about the upgrade cycle for future iPhone. The stock up almost 2%. In the context of the Vision Pro, the other news story that came out was that Netflix has opted not to create a Vision Pro specific app. In other words, you won't be able to use the Vision Pro to view content or material through a designated Netflix app, and instead Netflix will direct its consumers to other digital apps and web browsers for that tool. I don't think that had any sort of substantive bearing on the stock. Probably the biggest one of the last 24 hours is that Apple has lost an appeal to extend a pause or an exemption from that ITC band on its latest generation watches. And as of today, they will sell the Series 9 and Ultra 2 watch with the hardware capable of blood oxygen monitoring, but it will be disabled as that patent dispute with Massimo continues. And by the way, Manus, the Massimo CEO, will be on the show with me later today, and I invite questions from our audience around the world. But we're just at the beginning of this appeals process, and Apple is very much bullish about its appeal.
Yeah, you just wonder where the compromise in that deal is. Thank you very much, Ed Ludlow, with the very latest on tech and Apple. Let's stick with the theme. Amazon is making a restructuring deal with Diamond Sports Group that will save the local broadcaster from bankruptcy. Emily Gray-Foa joins me now. Emily, what's the rationale here for Amazon?
Well, Manus, that's a good question here. Amazon had actually been in talks with Diamond Sports Group late last year to come in and create this minority investment. And one positive here for Amazon is that now its users will be able to watch live MLB and NBA and NHL games through purchasing access with Diamond Sports Group. But I'll talk a little bit more about this deal because Diamond Sports Group, a unit of Sinclair, had filed for Chapter 11 bankruptcy last year, and they were actually talking about winding down the company until those talks with Amazon began. Yesterday, we saw the stock of Sinclair pop about 17%. Today, not moving that much, actually now in negative territory after the open. The Amazon stock just up a little bit higher, but we do know that there's still some talks about whether the deal will actually be able to go through. It does have to be approved by bankruptcy courts, and the MLB, the baseball league, actually said that this deal with Amazon was a big shock and will actually really change how the MLB does business with Diamond. But at least for right now, was good news for Sinclair and net neutral, it seems like, for Amazon stock right now, Manus.
Emily Gray-Foa, thank you very much for joining us. Let's turn our attention to financial services now. Discover reporting a 62% drop. This was in the fourth quarter profits. It continues to grapple with the fallout from risk and compliance lapses. Isabel Lee is with me in the studio to talk us through the discovery.
Hi, Manus. That's a steep drop indeed, and that led to the resignation of their CEO last year, if you recall. So the company posted fourth quarter profits of 1.54 cents a share. That's lower than Wall Street's estimates of $2.52 a share. Operating expenses also climbed around 18%, and the company is also expecting that their operating expense this year will increase in the mid-single digits. Shares of Discovered tumbled around 10% in pre-market trading, and now you can see that it's still continuing to fall roughly around 7%. The CFO said that fixing its compliance issues could cost the company around $500 million this year. This all began in July last year when Discover misclassified certain credit card accounts, which resulted in some merchants being overcharged, and it also resulted to their shares being suspended. And that was only the second time in a year that their company halted stock buybacks. Some silver lining, we have KBW saying that optimism could be found around net interest margin expectations and the reinstatements of their share buybacks. Manus.
Okay, Isabel, thank you very much. To Deutsche Bank's Pinky Chadra, let's talk about the target. 5,100 is the target price for the S&P 500 based on a number of factors. And this is what he wrote. We're going to discuss a number of catalysts that will impact the trajectory. Rates versus rates volatility, the playbook for geopolitics, geopolitical risks, and the sell-off, the widely anticipated mild short recession, and the presidential election. So there's a lot to unpack there, Pinky. Good morning. Good to see you. I'll ask you the same question as I asked my other two guests. You have a target of 5,100, which is a pretty significant number. It's a nice round number. How much of our journey to 5,100 is predicated on somewhere between 3 and 6 rate cuts?
For us, I'd say very little or nothing, basically. I think, if you think about the outlook 12 months out, and you think about it in terms of earnings and multiples, the main driver of the upside is really earnings growth. So our estimate for last year is $228. We don't have Q4 numbers yet in. But we go from 228 to 250 in our base case. So that's, a little bit less than 10% earnings growth. And that's really where the upside comes from. Multiples look, some people would call them pretty full. We would argue they're sort of just beginning to price in, basically, the recovery that actually has been taking place for quite a while. Whereas the macro consensus, has sort of continued basically to look for a very steep slowing in growth. It continues to do that. It continues to get upgraded. And that really keeps the bar for growth to surprise positively, keeps the bar very low, basically.
So, Bingy, there's going to be a number of people tuning in here, and they're going to listen to that, and they're going to say, so we're going to get from 4,700, call it for cash, to 5,100 with no rate cuts. Now, that's not going to be a one-way journey, because this market is emotional. It reacts to delayed rate cuts to a certain extent. So do you think in the near term, as we see delays perhaps to these rate cuts, some disappointment in equities, which sets up a better entry level?
What I would say is, I would agree with that. What I would say is that, the lesson of the last 2 years has really been that it's not really been about the level of rates or the fact that rates, are higher than they were a couple of years ago. It's really been about, very high rates volatility. And that's what the equity market has basically moved with. So, the market pricing in, for whatever reason, too many cuts, and some of those cuts come out, you're going to get rates volatility, and it's the volatility that's a negative. But the question is, will that volatility be sustained? So for that volatility to be sustained, things have to be continually basically changing, and there has to be a surprise. So would argue that, vol will come off as things settle down. And whenever vol has settled down, the equity market has basically rallied. So on the rates issue, I would argue it's really more about rates volatility rather than the level of rates.
Now, you remain neutral on megatech and on mega cap growth and tech. I'll get my sinking right in a moment. Neutrality. Why? Because I've got evangelist after evangelist telling me that AI, if it's got AI of substance and profit, it's worth having. Why are you neutral on mega cap?
Yeah, so I would say, we were long basically in late 2022 when there were no evangelists anywhere to be seen or heard from. It was basically at the bottom of the S&P 500. So we caught the rally in its entirety, basically. But by June of last year, in our view, it was really, we were very constructive on earnings and the fundamentals, but it looked to us that it was more than really priced in. The second point that I would note is I would take a little bit of exception to the AI and the AI hype. If you take a look at mega cap growth in earnings,
please do.
For the last 20, 25 years, what you will see is that basically, their earnings have been rising basically in a pretty steady trend channel. And yes, the pandemic took them to the top and a little bit above that channel. Fourth quarter of 2022, as the forward demand started to wane, the demand that had been pulled forward began to wane. We saw earnings go all the way to the bottom of the channel. And since the fourth quarter of 2022, what we've seen is a very robust recovery, almost back to the top. So the simple point I'm belaboring is that earnings have been in a channel for the last 20 years. They are still in that channel. So I would argue easily explained really by the cyclical surprise. And so far, there's nothing happening that suggests that there's higher upside. And that's actually why we are basically neutral, because what the market is pricing is that that we're going to go up and out of that channel.
Well, that's why we come to you, because you were ahead of the curve in the first instance. Can I ask you, yesterday we had retail sales. Today we've got nice jobless claims numbers. But I'm drawn to what Paul Donovan reminded me of from UBS. And this is just to get an idea from you about your consumer cyclicals. This is what Donovan said. Markets seem surprised by the US retail sales were stronger than expected. This is weird. Some part of the retail sales data surprised positively every single month during 2023. So my question to you on that is, you are overweight financials and consumer cyclicals. And you believe in the hedonism, I presume, of the US consumer? You're not worried about delinquencies, credit card spending? There's no level of concern?
Of course, you always have to be mindful of the risks. But given the world that we've lived in for the last year and a year and a half, which is almost every macroeconomist calling for a very steep and sharp slowdown, maybe into negative territory, maybe slightly positive, but a steep slowdown nonetheless. Mm-hmm. And what I would suggest is leave the narrative of the last 6 quarters, which really hasn't worked, and look at the data. I mean, if you look at PCE spending in the U.S., it's almost 70% of GDP. It's rising very steadily in a trend. On the good side, I think the story that is missed, so I'll come to retail sales in a quick second, but what we had is a tremendous surge for reasons that we all know and understand now, well above sort of trend levels at the height of the pandemic and the pandemic boom, so summer of 2021. Then we had a period of good spending basically going sideways. But since January of last year, they hit the trend channel and good spending has basically been rising steadily. So you could actually argue there's nothing to see here. Now, if you take retail sales, what I would argue is you want to look at them in real terms, because a big source of confusion has really been, how much is inflation, how much is real. Retail sales are, of course, reported in dollar and nominal terms. If you look at retail sales in real terms, you will see, again, that basically, we're rising pretty steadily in a trend channel. And again, there's not a whole lot of news. I would say that yesterday's print was a little bit better in the sense that within the channel, we moved up a little bit. But I would not argue that, it's a huge or a big change. What I would argue is that this has been ongoing for 3 years. It is the narrative that is at conflict with the reality. And so, we shall see who wins.
Yeah, as you say, it's putting the context around that consumer. I'm drawn to your thesis on buybacks. You played out very clearly what happened at the start of 2022, where we ended 2022. And typically when we start the year, we see lots of notes come out, get ready for buybacks, get ready for it. But you contextualize this as we are at the bottom relative to where we have been since the GFC. So it's not going to save my soul or my equity portfolio, a bit of buybacks this year?
I think, the things to note are that buybacks basically come out of earnings. And so, you use earnings to pay dividends, to do CapEx. And then, one way to think about it very simply is what's left over gets paid out as buybacks.
Yeah.
And what we have is a very large disconnect in 2023, which is 2022 earnings are coming down, so buybacks are coming down. In 2023, earnings rose, each of the first 3 quarters. Our estimate is that they did so again in the fourth quarter. And what you've seen is buybacks go sideways to actually slightly down. Mm-hmm. So the ratio of buyback payouts relative to earnings, has fallen sort of to the bottom of the range. First question is, why have they done that? We would argue it's the same story, which is that, it's the uncertainty about what the cycle is going to do and what growth is going to be. But growth's been above trend for 5 quarters prior to the fourth quarter of last year. So, and I think that, it's very likely that it'll be 6 quarters of above trend growth. And so at some point, if this cyclical uncertainty starts to lift, a catalyst number one should be the reality of the last 6 quarters. Then you should see buybacks start to come back. Buybacks since the global financial crisis have been, the largest basically source of demand for equities. Mm-hmm. And so our expectation is that buybacks will pick up in the first or the second quarter.
Okay, well, we wait for those to come through. Binky, thank you so much for being with us. That is Binky Chadha with his course 5100 without rate cuts that the market has penciled in. I just need to bring you a correction from a little bit earlier in programming. We played a soundbite for you for the spokesperson of Pakistan's government, and we accidentally said that they were from the Iranian government. We apologize for that mistake. Okay, let's turn our attention back to the World Economic Forum in Davos. Lisa Abramovich is sitting down with Breyer Capital founder and CEO. Lisa.
Thank you so much, Manus. Really appreciate that. I am here, so pleased to say, with someone who has intense experience in the technological world, Jim Breyer of Breyer Capital. I know that you work very closely with Steve Pagliuca. You have invested alongside him with the Celtics. We're not going to speak about that. But you also have been investing some similar ventures. And earlier today, he talked about how there is a feeling here that feels reminiscent of 1999 with the tech boom. Do you agree?
It's 99 in terms of walking down the streets and the buzz around Gen AI. What's different versus 1999? So I agree with Steve on 95% of his views, but the underlying technologies and the magnificent 7 or 8 companies are extraordinarily well-led and well-positioned into this new world. That wasn't the case in 1999, where there were companies like Yahoo that were not necessarily great leaders in the technological underpinnings of that next generation. So there are always differences. History sometimes repeats itself, sometimes rhymes, but what I would offer is I've never seen so much unprecedented demand, whether it's big banks, federal governments, leaders of Europe, and the entrepreneurial activities. I've never seen so much demand for what AI as a core in terms of simulation, new drug discovery. This is unprecedented.
And we've heard this from pretty much everyone. And this, to me, is really a key question. Is there a company that you see out there that is going to be a Facebook or a Microsoft in the world of AI in the future?
Well, I love that you mentioned Facebook. Mark is near and dear to my heart, a genius. I met him when he was 20 and invested and joined the board in 2005. Meta is extraordinarily well positioned in AI. There will be new Facebooks and new NVIDIAs that are being created. There's one very significant difference, again, versus the late 90s or the social networks of 2005. And that is interdisciplinary skills are more important than ever. So the days of me just backing the great team out of Stanford Computer Science or MIT or our other great universities, those are gone. There are certain investments that still work that way, but the big upside is, and this is public and private, where interdisciplinary skills in computation mixed with big verticals like finance and healthcare. If you don't have both, you're not going to be part of that next generation where we think of the Microsofts and Facebooks and where they've come from.
I know that you talk about certain verticals, in particular with life sciences. It's something you've been very interested in the sort of technology that can advance things there. I'm just wondering how actively you're deploying money now versus educating yourself with what's out there and waiting for the prototypes to become a little bit more solid.
Well, it's a wonderful question. Since 2017, I've invested in 12 spin-outs in the world of medicine, out of Memorial Sloan Kettering, UCSF, where we start with great medical professionals, doctors and nurses, and data that might be best of world at MD Anderson versus even our best cancer centers. So I've done 12 of these over the last now 7 years. And I have to say, it's been a phenomenal surprise. My job is to go out and now find the brilliant, genius 30-year-olds at Microsoft and Apple and Alphabet that want to do something very mission-driven. And the world of medicine and life sciences and how it's absolutely colliding with computation is something where I'm really finding a lot of receptivity for, again, that top 0.1% of machine learning, artificial intelligence developer.
Well, hopefully artificial intelligence can solve cancer and cure it in the upcoming
We're going
years.
to help.
I hope so. I hope so. Going forward, one thing that you've been very strong in is investing in China. And I do note that there is the biggest delegation here from China going back to 2017. How concerned are you about the ability to invest in a country that so many people say is uninvestable simply because of a lack of a certainty and certainly friendliness around the regulations?
Well, it's no secret we're at very challenging times in terms of the international politics. I never think of China, though, as uninvestable. We've backed, in the last couple of years, a number of wonderful entrepreneurs who moved to Singapore. There's no doubt that in the areas that I'm most passionate about, quantum and AI, all my investing for the last several years has been in the U.S., where I believe the best talent and opportunities are.
But are you still actively investing in China? Do you think that there still are plenty of opportunities, even as you said, the entrepreneurs are moving to Singapore?
I took an 18-month pause. So I paused about 18 months ago, even if it's an e-commerce company. There are some remarkable companies we invested in several years ago. Shein is doing quite well. But no, I think for the foreseeable future, although I'm not a political analyst, I don't see the U.S.-China relationship this year becoming worse. With the elections, I have no idea what 2025 looks like, so I've paused.
In the meantime, you were talking about how here at Davos you've met with a lot of generals and talked about AI and the use of it in war. How do you see that evolving as you kind of look at the landscape and understand what's going to take off?
Well, I've met with General Milley, admirals, and senior Secretary of State personnel. We're ahead in the U.S., but we all know that with AI, not just generative AI, but simulation technologies, what quantum will do to security, if our three-letter agencies, our Army, our Navy, our Air Force, isn't investing aggressively in these technologies, we'll be surpassed. The good news is we're well ahead, but there needs to be an understanding, and I think there is with the people I've spoken to. There's nothing more important than understanding what these new technologies mean in terms of national security. And I would also say I've met with a number of medical leaders in hospitals. Ransomware attacks last year in U.S. hospitals were up 60 6% each month. So 6x, 7x. Ransomware attacks for hospital and patient data.
Unfortunately, we have to leave it there. Jim Breyer, thank you so much for taking the time. Back to you, Manus.
Lisa, thank you very much. Great conversation there about the next generation of meta to come in our world from Davos. Time now for your trading diary. Let's see what you need to keep an eye on for the rest of the week. President Biden, he speaks at 2 p.m. on Bidenomics. Friday, you're going to get your U.S. existing home sales and more economic data from UMich consumer sentiment. We then close out with a little bit more Fed speak. San Francisco Fed President Mary Daly closes off the Fed speak before we go quiet. And tomorrow at midnight, the next U.S. government shutdown. That's the deadline. Let's see whether they can fill or kill on policy there. This was Countdown to the Open from Davos and New York. A very good morning.